Many real estate investors believe that qualifying as a real estate professional allows them to use their rental losses to reduce their overall income. And that's true. It does allow those losses to offset other income, but only when the requirements are properly met. The problem is, most investors don't qualify. And in a moment, I'm going to walk you through what actually determines whether someone qualifies and where many investors unintentionally fall short. You'll often hear that real estate offers significant tax advantages. And it can. But under the tax rules, rental losses are generally limited and don't automatically reduce other types of income. But there are specific situations where those losses can be used, and one of the most well-known is the real estate professional status, also known as REPS. Now, the real estate professional status is a designation under the tax rules that changes how your rental activity is treated. So instead of being limited the way it normally is, it allows those losses to offset other income, but only when the requirements are properly met, which is why it's one of the most sought after positions in real estate. But it's also one of the most closely scrutinized and frequently audited. So in this video, I'm going to explain what the real estate professional status is, where the misunderstanding usually happens, and why many investors assume they qualify when they don't. But before we get into that, let me briefly give you some context on where this perspective comes from. If we haven't already met, my name is Lisa Marie Odeja, and I'm a CPA and an Enrolled Agent, and I specialize in advanced tax strategy for real estate investors. Now, many of these concepts also apply to established, profitable business owners, but real estate is my primary focus. Before running my firm, I worked in federal auditing, where I conducted federal audits uncovering issues that resulted in millions of dollars being returned to the federal government. Today, I use the same experience, but from the other side, helping my clients to structure strategies that are not only beneficial, but also defensible, so they're prepared if an audit ever comes. Now, for the real estate professional status, it isn't based on one factor. It really comes down to how much you spend time in real estate activities and how actively you participate. The IRS looks at whether your involvement meets specific thresholds and whether real estate is truly your primary activity. And that's where many investors get tripped up. There are multiple tests involved, including time requirements and participation standards and how activities are grouped together. Now, most investors are familiar with the 750-hour requirement and the material participation. But the challenge is how those elements actually come together. Many investors are actively involved in their properties, but when everything is added up, their level of activity, it doesn't meet the standard required under the rules. So, on the other hand, when someone does qualify, their involvement tends to look very different. Their time is clearly documented, their activities are consistent, and their role is substantial. And that difference is what determines the outcome. And from an audit perspective, this is where issues come up most often. Now, because this isn't just a commonly used strategy, it's also one that receives higher level of scrutiny. And when those positions are reviewed, the IRS is looking closely at whether the activity can be supported. And unfortunately, in many cases, investors run into problems because their time isn't properly tracked, the records aren't detailed enough, or the activity doesn't meet the required level. And another area where investors run into issues, even when they are tracking their time, is that not all the activities actually count. So, someone may believe they've met the threshold, but part of what they're including doesn't even qualify. And there is another layer to this. Time is expected to be tracked as it occurs, not created later. But many investors try to rebuild their records after the fact, sometimes even during an audit, and that can be very difficult to support. And it often leads to those disallowed losses and additional tax, which is why simply reaching a number isn't the same as actually qualifying. And this is usually when investors realize what they thought qualified doesn't. So, when those requirements aren't satisfied, those losses may be limited or disallowed, sometimes discovered during an IRS audit. When those requirements aren't satisfied, those losses may be limited or disallowed, sometimes discovered during an IRS audit. This is also where having the right strategy matters, because real estate tax outcomes aren't based on one decision. So, when I work with clients, I take a holistic approach, looking at their overall structure, how their entities are set up, how their activities and time are documented, and how everything works together from a tax standpoint. The goal isn't just to claim one position. It's to build a strategy that actually holds up under the rules and works as a whole. In real estate taxation, outcomes are rarely driven by one factor. They're determined by how everything works together before the return is ever filed. Real estate can provide meaningful tax advantages, but the benefits only work when the position is properly supported. Because this is a powerful strategy, it also needs to be handled carefully. If you'd like to explore how these rules apply to your situation, you can schedule a brief consultation using the link below. If this was helpful, please feel free to like the video and leave a comment. That helps this reach other investors who may need this information. And if you know someone dealing with rental properties or questions like this, feel free to share it. And don't forget to subscribe so that you don't miss future videos on real estate tax strategy. I'll see you in the next video.